All right, so welcome you all once again to Target Professional Consult. We are going to scan through 2 questions before we proceed to solve one full question here. All those questions are critical for your exams. They are in the same neighborhood. So let us take notice of them. The very first question we are going to look out for is May 2019 Whole Limited. It's a question that is not user friendly, but it's a very good preparatory stone. So I'll solve it fully. I'll only walk you through how the complex issues could be dealt with. And then that is all. First, when you meet questions of this nature, do not waste your energy to read anything until you follow these principles. Go to what you call the RATs or the RAF approach. Go and read the requirement first and set your tone for the requirements. When you come back, you do your workings one first, then you read the footnotes, then you scan through the financial statements. That is what you have to do. So for consolidation, follow this approach. It has been tried and tested. First of all, let's go through the requirements. It says that prepare a consolidated statement of profit or loss and other comprehensive income for the year ended 30th of September 2018 for whole group. Yeah, so right after reading the requirements, you go straight to your answer booklet and check the question number. In a typical exam setting, it will be question 1. But kindly check for this. Kindly check for this. They may choose a new syllabus or a new section. The question number may be swapped, but we don't think it will be like that. So question 1 will still be on consolidation. Thank you. Whole group, that's the parent name. Then you only have to add the word consolidate. Consolidated statement of profit or loss. Then we are good to go. To say consolidated profit or loss for the year ended '30th September 2018. 30th September. (2018). Then you check the reporting currency. How was it stated in the question? So you don't need to assume any reporting currency other than the one you see in the question. So here is Ghanaian cedis with 3 zeros raised on top. The same show here. the entire first page will be enough for your comprehensive income. But if you really doubt it, you can still create first and second pages. So you create first and second pages for that. So on your next page, which will be page 2, you go straight and write workings. So repeat the question number here and say workings. Don't forget the comprehensive insurance. What is a comprehensive insurance? The comprehensive insurance is that you write here all figures are in Ghana cities of thousands. Then close it. Then write here workings 1A. Your group structure is the first thing you have to do in the exams. Whether the console question is user-friendly or not. Whether it is user-friendly or not. This is what we have to do. So you go and read the information, the area that will assist us to determine the group structure. Any other information, don't bother yourself to read it for now. If care is not taken, you won't be able to finish your corporate reporting exams. So in that case, you need to be a bit fast. Usually, check the top. If you check the top, it's not there, check the down. So the information is here. So I've seen acquisition story.
Target.
Yes, please.
Please, my phone has formatted. Kindly resend the question to the page for me, I beg you.
Okay, so with this question, we will not solve it fully. We are scanning through. It is May 2019, the past question. Or which one again? It's also on the portal. Where again can we find this question? I don't have this particular question in single. It's in a bulk file. But it's all over. It's 716 pages document. So I'll see if I can add it to your intervention material. But I just don't want to load your intervention material with a lot of items so that it will be very scary. No. We are not into scare people. So let me show you where you can get it. If you have access to the portal, you go to the questions and answers. ICA past questions, all of them are available. You locate May 2019 question 1. We are scanning through it. It looks similar, almost the same as the question that we recently solved. What's the name of that question? Target group. Good. So the target group we solved looks similar to this. So what you have to do is establish your group structure. It says that on 1st October 2016, who acquire 60% equity interest of Sunyani, a public limited liability company. All the rest I don't need it for now. What I need is a control holding. So I have to go to Ho and Sunyani. So once I've gotten Ho being the parent acquiring, let me put Sunyani here. Sunyani. Sunyani Limited. Who acquires 60%? That's it. I am interested in a control structure on October 1st. I'm not interested in any other stuff again. So let me continue. They say Ho Limited dispose of 8% of the equity shares in Siani on September 30th September 2018. It's not a reporting date. Yeah, so exact reporting date. So right here, disposal. It disposed 8%. This is how you have to approach questions. The rest of the story, I'm not interested. I'm only interested in acquisition. Who acquires 60% of the equity interest of Kumasi? Oh, there's another company called Kumasi who acquired 60%. So let me go and write Kumasi, bring Kumasi here. 60%. Let me check and see if there's no other issues on disposal again. It's continued again, said that on April 2018, Ho disposed of 40% equity interest in Kumasi. For a consideration of this, I don't need a consideration for now. Now, Ho disposed of 40% of a stake in Kumasi. So right here, 40%. What will be the group holdings? What do you think will be the group holdings? Okay, so kindly ask.
Target, my problem is that, the acquisition date is different from the disposal date.
Yes, please.
So why I thought you first do the group structure without disposal, then you go ahead and do a different group structure with disposal.
Oh, we always want it to be in one. Then when you are done, you do analysis of NCI. And there's another portion where we have effective date of acquisition and period of consolidation. It will be very clear over there. We will do the demarcations there. Agreed.
Okay. Because here, when you do it like this, like the initial NCI, you won't know.
Oh, we'll do the
That's
analysis of the NCI.
okay.
It becomes a footnote to this.
Okay.
So therefore, if we have 60, we dispose of 8. It means the group have 52%
Yeah.
and 20%.
20%. Yeah.
When you are done with this, then you do your analysis of NCI. When you write the NCI figure here, you must provide extra analysis of NCI. NCI will be 48%, then dash. Do your analysis of NCI. Analysis of NCI. Check the dates. When did the disposal took place. Let's start from the first one, Sunyani, 8%. The 8% took place on 30th September 2018. That is the last day of the year. The last day of the reporting period. Because you are reporting as at 30th September. On that very fateful day, we disposed 8%. So let me add it here, 30th of September. (2018). So that's the end. Please, if the year end is 30th September, where will it start? So for Sunyani, from 1st of October, it will start from October 2017. So 30th September 2018. NCI figure would be what? 40%. Indirectly, we'll not even use the 48. There's nowhere you use the 48. It's the 40 that you're going to use. Let's confirm the same thing for Kumasi. When was the disposal? We acquired Kumasi 30th September 2016. So that will be about 2 years ago. That's so good. But on 1st April 2018, please, how many months to the year end and how many months after the year starts? If our year will end 30th September. Meaning from 1st October 2017 up to 1st April 2018. How many months? Indirectly, we are ending at March. So that will be 6 months. We agree that is 6 months. So the NCI will be 40%. So for Kumasi, from 1st of October during the year. October 2017 to 1st April. NCI will be it will be 40%. The NCI will be 40 because we have 60 there. That is all. Your next working you have to do, it should be what we call effective date of acquisition. So for Kumasi, for Sunyani, let's go. Which one is available? Sunyani own is on top here. Sunyani own is 60%. 1st October 2016. 1st October 2016. That of Kumasi. Let's go to Kumasi. No two. Kumasi's acquisition occurred 30th September 2016. 30th September 2016. So that is how you do it for us. Then you go to number C, period of consolidation. For that of Sunyani, even though we have made a disposal, we still maintain control at the end of the period. Hence, we will consolidate Sunyani on a full year consolidation. So for Sunyani, you can just write full year consolidation for us. Full year consolidation. Then for Kumasi, let me start Kumasi own. You see, Kumasi, even though we acquired Kumasi 30th September 2016, indirectly the same as 1st October 2016. But the disposal of Kumasi made the whole group lost control. And once the control is lost, we cannot consolidate. But we can consolidate before. Don't forget, he was 6 months with us. So here, since it was disposed of, you tell the examiner that, examiner, I'll do, yes, please. Some of these missiles, they are either that they have All right. All right, so let me summarize things here. So for Kumasi Limited, you tell us that you do 6 months consolidation. 6 month consolidation. And 6 months associates. Because of the disposal during the period, we will only consolidate Kumasi for 6 months and another 6 months being associate. That's all. Any question the examiner give it to you, this is what you have to do first. Failure to do this may cause a deviation, may cause a danger, may cause a disaster, may cause deviation. So I'm done. Step by step. And this will fetch you marks if you're able to do this for us. All right. Next show. Now that you've established, the most important bit of consolidation is the period of consolidation. We are consolidating Sunyani full year, and we are consolidating Kumasi 6 months and associate. So go to your P&L. Now start. Do not listen to anybody. When they move, you move. When they stop, you stop. Parent plus the subsidiary. So you start like this. Revenue, parent owned plus Sunyani, open a bracket. Then times 6 out of 12 of Kumasi's own. That's all from the start to the end. So open your revenue. That examiner 200 plus 4 of Sunyani. Sunyani's own is what? 57,500. Sunyani is 57,500. Sunyani's own is 57,500. I love this question. 57,500. Plus 6 out of 12 because of the disposal times 35,000. Leave it. That's all. Go to your cost of sales. Cost of sales. The same show. Cost of sales, what do you do? 156,000. 32,500. 156,000 plus 32,500 plus 6 out of 12 times Kumasi's own 18,000. Like that, you continue with your gross profit. When they move, you move. When they stop, you stop. So I'm assuming that you can do this for us. The assumption is that you can continue. And we are good to go. All right. Now back to the question. Please, you copy everything. Line by line consolidation. The line by line. Please, the last time question we solved, we made a comment that when there's associate, where do you open? And when there's the disposal, please, because there's associate and disposal in this question, because there is, let me write it down. Tomorrow's week, Monday, you remember, Target said it, that when there's a disposal in the question, and there's associate in the question, disposal require a line item in a P&L, line item, to record the profit or loss on disposal. Again, associates, it also require a line item. A line item to also record what we call profit, share of profit from associates. So we call that one share of profit from associates. You can decide to put all of them either before or after finance cost. To locate your finance cost. Finance cost is here. They should come before finance cost, right before finance cost. Assemble all of them there. That is all. Right before finance cost. Assemble all of them there. And you are good to go. All right, so that is what you need to do when there is to try and bring this line item. Right from gross profit, they went to admin. Okay, other income, admin, and other expenses. So they went to other income. You open your brackets, you do it. They went to admin, administrative expenses, you open your brackets. Then they went to other expenses, Down to you open your brackets. Right from there, they went to finance. Okay, operating profits. They went to operating profits. You bring the operating profits in here. Right after that, locate share of profits from associates. Please go ahead and write share of profits. Even if you go to the exams and it is negative, a loss, still put it in bracket, you are right. So don't be worried. Then write here profit on disposal. That is all. Then you continue adding them, you get PBIT, profit before interest and tax. Then you continue the journey. Continuation, you go to finance cost, finance income, profit before tax, line by line, up to the very last item. Line by line, up to the very last item. So you do this up to total comprehensive income. The 3 dots means that aluta continua. Repeat the same story. I'm only scanning through this question with you. Then you share the profits. Third examiner, profit after tax. Attributable to the owners of who? NCI and parents. Again, you have to also share the total comprehensive income. It's a must. But many people don't reach here because they feel like their profit after tax is wrong. So they will not even bother themselves to share. However, the NCI figure is free. However, NCI figure, you don't need the NCI figure, you don't need to get the profit after tax correct before you can get that figure correct. So take notes of that one. All right. We are through. When you're done with this, you continue your workings. When you're done, where do you start from? Because there is disposal in a question, there will be a need for you to calculate the goodwill. So you do your goodwill calculation. So you see, the examiner have 8 parts. When you are done, your next working should be the goodwill. Goodwill computation. That should be your next working. In attempt to calculate the goodwill, you will need the net asset of the subsidiary. You will need the purchase consideration. And then the rest. Right after the goodwill, your next working should be the disposal. Profit or loss on disposal. Use the same format we did the last time. Now let me go through the footnotes one after the other to explain how they will affect it so that in your spare time, you will do it and I move on with it. This question is not different from the question we solved in class. The last time we did a question called target group. We have done a question called target group here. This is the target group question I'm talking about. It was also a step disposal. It's the same thing. Let me show you something here. From gross profit, we normally move on to where? Other income, admin, and other expenses. It's still the same as the question you are seeing here. That is how questions are being articulated or set. So in that neighborhood. Now let me scan through the notes, then I move on to the next section. Who wishes, okay, let me start from the top. On October 1st, 2016, who acquired 60% of the equity interest of Sunyani, a public limited company in Ghana. The purchase consideration is made up of a cash, 40 million, and the fair value of the identifiable net assets acquired was 55 million at that date. The NCI, the fair value of the non-controlling interest in Sunyani was 22.5 million on 1st October. First line, if I should end here, calculate the goodwill. You see? So the goodwill calculation, it has been made simple. Questions of this nature will not worry you with goodwill calculation. The goodwill calculation is not complicated. This is the purchase consideration, 40 million. And the fair value of identifiable net assets was 55. NCI is 22. So here, you don't need to worry yourself. Once I have the fair value, I can go ahead and calculate goodwill. Goodwill method is what? Full goodwill method. So purchase consideration of 40 plus NCI 22.5, making 62.5, less 55. That's a goodwill. No two ways about it. So get the goodwill figure, correct. So the share capital and retained earnings of Sunyani were 12.5 and 32.5, respectively. The other component of equity was 3. If you add all of these figures together as the net assets, it will be less than the total net assets given to you. Try and add them and let's see. They are trying to give you the breakdown. Share capital is what? 12.5. Please plus 32.5, what do you get? So 12.2 plus 32.5. At the end of the day, you get 45. 45 plus 3, you get 48. So if the net asset is 55, and we have 48 as a breakdown, then there is fair value adjustment. The difference, which will be 7 in number. 7. So they say the excess of the fair value of the identifiable net asset at acquisition is due to non-depreciable land. So here it means the fair value adjustment, it will affect OCI. So you go and just add 7 to OCI. That's all. It won't go anywhere again. You are done. Then he said that goodwill has been tested for impairment annually. And as at 30th September, it has reduced by 20%. Yeah, I can get a goodwill figure. Anyone on the calculator should give me the goodwill figure. 40 plus 22.5 minus 55. Someone on the calculator should assist us, and we are good to go. So that is all. They say it has been impaired by 20% as at 30th of September 2017. So that is at the beginning of the current financial year or at the end of last year, the goodwill has impaired by 20. No other. However, at 30th September 2018, the impairment of goodwill had been reversed. And goodwill was valued at 1 million above the original value. That means it has been reversed by 1 million. This upward change in value has already been included in the draft statement of work below prior to the preparation of the group account. Please and please again. Please and please again. You can reverse impairment on any assets. Impairment on goodwill can never be reversed. Let me repeat it. You can reverse any impairment. You can reverse impairment on any asset. However, impairment on goodwill can never be reversed. So here, we'll bring back the 1 million. So the 1 million, we will not agree with the reversal. That is all. You see how nice the case is. I'm done with the issue.
Second, please repeat that explanation.
All right, so what happened is that, let me give practical scenario. 60, let me use my calculator. Let's just assume that you have a goodwill as at 30th of September 2016. The goodwill calculated is somewhere, let's say 20 Ghana cedis or 20 million. Then exactly 1 year later, 30th September 2017, there was an impairment of goodwill by what? 20%. Find 20% of, let's say, impairment of, 20%. Find 20% of 20 for me. What do you get?
4. Okay.
Good. So that will be 4. So that means the current amount of the goodwill would be what? 16. Then as at 30th of September 2018, at the reporting date, this goodwill, they said that it has been, the price, the value of the asset has been improved. So the goodwill figure has gone up to 17. So there has been a gain of 1. So that 1 million gain, a gain of 1 million. They have used the 1 million to reverse the impairment. So indirectly, they are trying to tell us that 20 impairment here no longer before. It will be what? 3 million. Because they have used 1 million of the gain to reverse a portion of the impairment. So now the goodwill have to be 17. And we are saying no. IAS 36 made it so clear that impairment on any asset can be reversed. However, impairment on goodwill is permanent. So even if we impair the, once we have impaired the goodwill by 4, subsequently, when there's a good news and there's a gains in the assets, we can never come back and say that we have made a gain of 1 million. So we are using it to reverse previous impairment. I hope it's very clear. I hope it's clear. So we have to reverse the 1 million. How do you reverse it? How? 2 entries. When they recorded the gain, impairment is in the P&L. So, and they have made a gain. So they've taken this gain to the other income. So you go to the other income, and reverse it from there. Or if they have added it to admin, if the reversal took place in admin, you take it off from admin. When you go further, probably they could tell us where exactly they've done it. And then that is all. So this upward change has already been included in the draft financial statement of who? No. So who has recorded it in its other income? Or in admin expense, you are reversing it. What happened is that he has recorded a gain of 1 million to reverse impairment. He will not agree with that gain. Instead, it must go to OCI. That gain should go to OCI, not the P&L. Among these three items, you see, impairment is included in admin. So if there is a reversal, we assume that the reversal also took place in admin. So therefore, they have subtracted 1 million. We're adding it back. We're adding 1 million back. That's all. That is how that note will be. Now, let's go to.
Okay, if you say they have subtracted,
Yes, please. If it's
they have
admin,
added or subtracted, because they are saying that the goodwill, they are assuming that it is a reversal. They can't reverse, so they are assuming that there's that use the word income of 100. Even
okay,
though
so
if
what
it's a
happened
reversal,
is that they have treated it as a gain.
yes, they have treated that again.
When again, cost, what happened? Admin is a
It
cost. So it
reduces,
means that
it reduces it.
they have subtracted 1 million.
Yes, so it has reduced the value.
The 1 million is a gain. So we are reversing it, adding it back to clear off what they have done. In events where they have added it to their other income, that one needs to be positive here. Because it will be a gain, it will still come and then deduct it. If it's in other expense, if they hit it against other expense, they will still subtract. We'll come and add back. That's all. Agreed.
No, I don't agree with you. I'm looking at it that since it's an expense and an income has come in, it has come to reduce the value of the expense. So it's assuming the 7.5, assuming the 7.5 that is showing as administration.
Here, what it tells that let us know they hit it against admin. The original admin cost is 8,500.
Yes. And they brought in an income of 1,000. It has come to reduce it to
So it has
7,000.
come to reduce it here. And we said
Yes.
that we not agree for them to bring this figure here. So what do? You add back. So what can I do?
Add back. Yes.
So we are adding back. That's all.
Okay.
Agreed.
Yes, agreed.
So we are adding back to it to reverse the reversal they have done. So whatever they have done, do the opposite. All right, so note 1, there's no issue here. It's just a good old calculation. The disposal, you just have to calculate the gain or loss. Please, here control is not lost. They owe 60%, they dispose 8. They still maintain control. In that case, we call it the transaction between equity holders. So, the profit or loss will not hit P&L. Take notice. Profit or loss never hit P&L. It's what you call OCE. OCE. So you calculate it, and after calculating it, if it's a gain, you go and add it to your other component of equity. If it's a loss, you go and subtract. But you can decide it will pass through OCI before hitting the equity. It does not go to P&L. But the mistake is that the examiner will create an intentional mistake for you to solve. What will be the mistake? The examiner will deem that profit or loss as a P&L item. For example, who account for investment in subsidiary using IFRS 9, OUA, financial instrument, and has made election to show gains. Look, in other comprehensive income, the carrying value of the investment of Sunyani was 45 million at 30th September 2017 and 47.5 million at 30th of September 2018 before the disposal. So here you can see that there has been a gain of 2.5 million. So here we'll do a reversal of that from the OCI. And then we will calculate the gain on the disposal of the 8. That is all. So the full question, I've done it in there, and you can easily go through it to look through. That note is done. The note 2 has to do with the acquisition of Kumasi, and they give us the purchase consideration to be 35 million. Identifiable net asset was 43. NCI is 14. So we can still calculate what? The goodwill. So that would be purchase consideration of 35. NCI of 14, 35 plus 14. That should give us 49. Then fair value of net asset is 43. So 49 plus minus 43, that should give us 6. So goodwill should be 6. You are good to go. Then after the disposal, they receive a consideration of 25 million. From here, going, use it to calculate what you call profit or loss on disposal. Use it to calculate profit or loss on disposal, as we did the last time. Follow the same scenario to calculate it, and you are good to go. We've done similar version of this. So follow how we calculated it and do the same for this. We are good to go. Then the third question said that this is where my concern is. Who sold inventory to Sunyani for 6 million at a fair value? Full stop. Please, once who sold to themselves, you don't need to continue again. The entire sale, the gross sale should be eliminated. Where do we eliminate it? Both in where? The gross sale should be eliminated from revenue and so minus 6 million. Both revenue and cost of sales. That's all. Whether there is unrealized profit or loss, whatever, you must still eliminate. Then continue the story. Say who made a loss on a transaction of 1 million. Sunyani still holds 4 million in event. So there's a loss. Please, do you eliminate unrealized loss?
No, please.
Come again.
No.
Good. So we don't eliminate unrealized loss. So that's all. So there's nothing you do again. So all these figures here, they are there as a trap because there's unrealized loss. Please, we only eliminate unrealized profits. Unrealized loss, we want it maintained. That's all. Note 4 on October. Now, right from here, consolidation notes, they are done. Now, right from here, they are done with consolidation ends there. The rest will be normal IFRSs. About 2 to 3 of them have to be normal IFRSs. So note 4, there was a third IFRSs. Now, this is normal IFRS. So we say that who acquired, who purchased on 1st October 2016, who purchased an item of property, plant, equipment for 6 million. This is to be depreciated using straight line basis over 10 years. So then calculate the depreciation. 6 million, that will be 6,000 divided by 10. So 1 year depreciation is what? 600 Ghana cedis. I've raised 3 zeros. At 30th September 2017, how many years? This is 1st October 2016. 1st October 2016. 30th September 2017. How many years? That should be 1. So find the current amount of the item. So that will be 6,000. Current amount will be 6,000 minus the 600. That will be 5,400. That's all. On that date, the asset was revalued to 6,500. So this is the revalued amount of fair value. Will you get gain or loss? Will you get gain or loss?
Gain.
A gain of 900, right? Automatically, where will it go? This is
OCI.
OCI. This is 30th September. So they have already recorded it. So I don't want to see this 900 in your current year account as gain. No, because check the date. 30th September. We are reporting when? September 2018. Now let's continue. If you end here, the new depreciation will be what? 6,500 divided by what? Is it 9 years or 10 years?
9.
Good. What do you get?
$722.2.
Good. I can still find the carrying amount. What will be the new carrying amount? 6,500 minus 722. Answer.
5,777.7.
5,000.
777.
Okay, so let's say 778. They will give you another revalued amount again. So they say, but on 30th September 2018, the value of the asset had fallen to 3,500. Is it a loss or a gain?
A loss.
A loss of a loss of a loss of
2,278.
2,278. The question is that this is a loss, revaluation loss. It can be impairment loss. I'm expecting the examiner to make it impairment loss. Maybe the next time. Whether impairment loss or revaluation loss, they have the same effects in this context. All right. Now, you have made a loss of 2,278. Meanwhile, last year you made a gain of 900, so you cannot record the entire loss. When you made a gain, where did you record it? The gain went to OCI. So wherever the gain went today, remit a portion of this loss to wherever the gain is. So it means that 900 of today's loss have to go to OCI to reverse. So go to OCI and subtract 900 from it. Then the remainder is an expense. Add it to other expense or admin. Anywhere, you are right. It ends the story. That's all for this footnote. Nothing else, nothing more. Last footnote. And I'm done with this question. The rest is for you. On October 1st, any question? No. On October 1st, 2016, Home made an award. The good news is that most of all the IFRSs in Console always affect the parent. The day the examiner will change his mind, he will let all of them affect the subsidiaries. That one to be a disaster. We will call it national funeral. Earthquake. Because if a lot of standards affect the subsidiary, it will make the consolidation a bit complicated, and the likelihood of getting a lot of things wrong will be high. So that is why on good news, examiners try as much as possible to let complex IFRSs affect parents, so that even when you are unable to do it, your consolidation issues will still be the same. So note 4 and note 5 has nothing to do with the consolidation issues. It only affects the parents. Good. It says that on October 1st, 2016, Home made an award of 4,000 share options to each of its 7 directors. The condition attached to the award was that the directors must remain employed by Home for 3 years. The fair value of each of the options at the grant date was 100 Ghana cedis, and fair value of each option at 30th September 2018 was 110. This is IFRS 2 share-based payment. At 30th September, it was estimated that 3 directors would leave before the end of the 3 years due to economic downturn. The estimate of directors who were going to leave was revised to 1 director at 30th September 2018. The expense for the year as regard to the share option had not been included. So here, this is share-based payment. Very nice share-based payment question. In a share-based payment, don't worry yourself. Do your workings like this, share-based payment. Put equity here and then put the expense here. Then start the first year. You can say year 1. Look for the number of employees, number of directors who are likely to vest, who are likely to stay up to the end of the grant date or vesting date. So they say 4,000 share option to each of its 7 directors. Directors are 7. As at the end of where? At 30th September it was estimated that 3 directors will leave. So please, if there are 7 and 3 will leave, how many people will stay? Yeah, 1. We are 7 in number. And 3 will leave. 4 will stay. How many shares are they giving us? 4,000 shares each. What's the fair value of the shares at the grant date? 100 cedis. There are only 2 conditions. Yeah. How many years? Is it 3 years? It should be 1/3. This is what you get with your calculator. This share-based payment. It came last sitting. And the question that came last sitting was a little question we solved. All right, what do you get as your final answer? Okay, so let me do it here. 4 times 4,000 times 100. So I'm getting 1.6 million. Answer divided by 3. 5 and plenty 3s. So I'm average 3 zeros on top. So get 5,000 and plenty 3s. Repeat the same thing. First time provision is an expense at the same time a liability. This is a first time provision. So it will still hit 2 entry or else it won't balance. Debit and credit. Then the year 2. That's the September 2018. How many people are expected to be around? Due to economic downturn, the estimate of directors who were going to leave was revised to 1 director. So the total was reversed. So if 1 director is going, then out of the 7 directors, it will have a 6. Times 4,000 shares we are giving each person. Times 100 Ghana cedis. This around times 2/3. So 6 times 4,000 times 100. That's 2.4 million times 2 divided by 3. You get 1.6 million. So that will be 1,006. Find the difference between. I show this answer now. No, this figure, I don't really try this figure. 4 times 4,000 times 100.
That's
That's what.
correct.
No, divided by 3. It is 500, not 5,000. You get it? Good. So you compare. What is the difference? So 1,600 less 533. So 1,067. This figure goes to the expenses. You add it to admin expense. That's all. That is all about this note. So the plenty note. You see, they gave us the fair value of the shares as of September 2018. Please, we always pick the fair value of the shares at the beginning of the contract. We call it at the grant date. and then we are good to go. So on that note, I'm done scanning through this question. The last question I'm scanning through is Laboni. It's also step disposal, but that one is of balance sheet nature, not P&L. It's a step disposal in the case of what? P&L. Step disposal in the angle of what? P&L. This one is a step disposal in angle of financial position. All right, so, and the question is August 2022, Laboni group. So that's the next question we are looking at for August 2022, Laboni. Laboni. Laboni group. Laboni. August 2022. Laboni. It's a step disposal with balance sheets. Step disposal with balance sheets. So below is a summarized statement of financial position with three entities: Laboni, Nungwa, and Teshi. Laboni, Nungwa, and Teshi. Let's go straight to the requirement and be sure. For you know, it will be ratios. Prepare the consolidated statement of financial position of Laboni Group as at 31st December 2021. You follow the same storyline. The same storyline. The name of the company. So here too, right after the requirements. Question 1, Laboni Group. Laboni Group. Right here, consolidated statements of financial position. As at, let's go and code it. As at 31st of December 2021. Oh, that's a good year. 31st of December. Now, the next show has to be like this. Your reporting currency. Check the reporting currency well. It's in millions. As they've written it, so as you must also write it. Failure will cause trouble. So your reporting currency should come. Then right after the requirement, you pause. Go to your workings, still question 1. All figures are in what? Thousands of series. Your workings 1A, as usual, group structure. Don't change the approach. So now let's go and establish the group structure. It will give us the comfort to do the consolidation well. Go to the additional information. This one, the top doesn't have plenty storage. On January 1st, January 2018, Laboni acquired 80% of the shares of Lungwa. At the same date, Laboni acquired 70% equity share of Teshi. Hey. Laboni, take your time. Oh. Why do you buy companies on the same day? Oh? On the same day, 80% in Lungwa and then 70% in Teshi. So right here, Laboni. Right here, Lungwa. Teshi. 80% here. 70% here. That's all. On the same acquisition date, which is 1st January 2018. Let's continue reading. You establish the tone. All these are acquisition stories. They say on October 1st, 2021. Meanwhile, we are preparing the financial statement up to 31st December 2021. So, Laboni disposed of 40% out of the 70% of the equity share. So 1st October 2021. We sold 40. So as of 1st October 21, we made a disposal. A disposal of 40%. Let me finish scanning through. Be sure that we have not sold anything again. Here, no. Here, they've not sold anything again. So we are done. We still get 80%. Here you get 30%. NCI. This one is total group holdings. NCI over here will be 20. Here will be dash. And you do your NCI analysis. Now, let's check something. Here, what is the effective date of acquisition? effective date of acquisition will still be 1st of what? 1st of January 2018. 1st of January 2018 for all of them. Number C, period of consolidation. Dunga is a full year consolidation. But Teshi, because Teshi was disposed when? 1st October. From 1st October to the year end, how many months? 1st October to the year end. How many months? Or from 1st January to 1st October, how many months? All right, so it will be 9 months. So here for Teshi, consolidation is 9 months. So 9 months consolidation, 3 months associates. But because this is a balance sheet, we will not do any consolidation. It's only when we are doing profit, then we'll take 9 months into consideration. So on that note, we have established the point that Teshi will not be consolidated. So for balance sheet, you create your goodwill column. So now it's only Laboni and Nungwa we are adding. Parent from Nungwa, Laboni plus Nungwa, Teshi's item will not be added. So this is a balance sheet, not P&L. So it will be only parents plus the first subsidiary. Parent own plus this. Please balance is no 9 months, no 6 months. Either we are adding or we are not adding. That's all. So no consolidation for Teshi. Then you leave an investment in associates. Create your column. So among the non-current assets, you need 2 additional space, goodwill and investment in associates. That's all. Then we are through. So that is what I want to explain to you. The rest of the story is still the same. It's not something that is too problematic. All right. We have to follow the same sheets. And then you are good to go. If you have any question, kindly ask before we say bye-bye. My main question for the day has to be joy. I've shared with you, you can scan through it, and then we are good to go. So The main issue is what we have discussed. The rest are normal story. You should know. Through my next question I have to discuss with you is called joy group. But before that, if you have any question, you let us know. Before I continue with the game.